Hey, everybody. Welcome to another week. We're calling all investors. We're here live with Caeli Ridge, with Ridge Lending Group. And as always, we love to remind you, you need to pick up the phone and call in to 855-74-RIDGE or email to info@ridgelendinggroup.com. And that's because there is no one else that actually is able to pick up the phone as soon as you call in and talk to you and give you perfectly correct information and stay with you throughout. Lots of folks that are calling in are still unsure about how to take care of their real estate investments, and Ridge Lending Group is here to help. So today is October 11th, and Caeli and I are back from our world travels. I'm obviously still sick. If you can hear it in my voice, I'm really sorry if I accidentally cough on you. It's through the camera, so I'm pretty sure you'll be safe. And Caeli had a wonderful time in Hawaii. What a great place to go. We're going to talk a little bit about that. But today's topics are open Q&A, first of all. So make sure if you have any questions that you use the chat feature, or feel free to take yourself off of mute and go ahead and ask the questions. We'll take it as an open forum. We're also going to be talking about the reasons and methods for cashing out or harvesting equity. We're going to talk a lot about that, especially with property values starting to go down, which we did talk about that last month. So hopefully people paid attention. And the last thing is to continue to have the discussion all about owner-occupied loan options. We are still seeing a ton of opportunity for clients to leverage their owner-occupied situations. So that's what we're doing today. And of course, we have lovely Caeli Ridge here, and welcome, Caeli.
Thank you, Larry. Hi, everybody. As always, thanks for being here. Q&A, we'll just leave that open through the next 30 minutes. So anybody that has anything, just feel free to unmute yourself, like Larry said, or put it in the chat. Anything that's top of mind, that's come up, that maybe you had questions about over the days and weeks and months this year, forecast, whatever it is, feel free to put those in there for us. And while we're waiting for those, why don't we talk about cashing out? I'm getting this a lot. More often than not, I've got people that are calling and saying, hey, I'm starting to see values in my neighborhood. People were telling me that values weren't going to go down, but I'm starting to see values go down. Did I miss the boat? Am I not going to be able to get access to that cash, whether through a cash out refinance, or most of you that are here today probably remember us talking recently that we have Helocs available for owner occupied, second lien HE loans for non-owner occupied. Obviously, we always have that all in one. I do want to, if I remember at some point in the next 30 minutes, I want to mention the all-in-one again. Some of you may be tired of me talking about this, but I think it'll be an important talking point for the things that I'm seeing. But cashing out, why would you want to do that? Why would anybody want to cash out? For obvious reasons, for those of us on this call, we are real estate investors, so we want to harvest our equity. Borrowed funds are what? Non-taxable, right? We want to borrow against the equity in our existing properties, primary or rentals, and we're going to use those and parlay them into purchasing more real estate. Even if you're not purchasing right now today, I'm going to encourage you guys. I've been beating the drums about this for months and months. Home values are going to come down. So two things are going to happen here. If you haven't done it and you had intentions to do it, or you're thinking about it, do it now. Because yes, your home too, the value is going to come down. Grab the cash that you can before you don't have access to it. As the second part of that, the two things, we want to grab it before you don't have access to it, but then also have it accessible and ready to purchase properties that are also going to be of a lower price point, right? If you have not prepared for that, you're going to miss the boat. So I can't stress that enough. Get ready. Because this particular cycle, all investments are cyclical, right? And I think that in particular, real estate investments are specifically cyclical. This is another cycle. I've lived through, I'm going to say 2.5. So I've been here, done that kind of thing. I've seen the different parlays for cash flow, appreciation, crashes, mortgage and housing. You guys have heard me talk about all that, but we're right at the beginnings of the next. So just be ready, right? Don't wait. I've done that. I've been in this space long enough that I didn't know what I didn't know, and I missed several boats that if I had been informed and jumped on when I should have, I would have been further ahead than I am now. So please take my advice and be ready for that, because it's coming, it's here, whatever you need to do.
We did have a
You got equity,
question.
get it. Yes.
We had a quick question, and I think there's a couple questions inside the question. So Brock, thank you for asking it. So the question, Caeli, is, does Ridge Lending Group have any loan products in Ohio, even the non-QM? So it's probably worth spending an explanation of what is non-QM and then talking about Ohio.
The answer, Brock, thank you for your question. Yes, we have loan programs in 47 out of 50 states, and most of what I'm about to go over will be applicable to all 47. The 3 states that we're not in currently are North Dakota, New York, and Vermont, right, Larry?
That's right.
Okay, so anywhere else, the following is going to be applicable. Agency, Fannie Freddie, golden tickets. I'm not going to spend too much time there. Everybody on this call, I'm sure, is familiar with what those are. Let's take a minute and talk about non-QM. So for those of you that are not familiar, the definition of non-QM, first of all, QM stands for qualified mortgage. Fannie Mae, Freddie Mac, that is the epitome, the definition of what a qualified mortgage is. So it's deemed in our industry that everything outside of that underwriting box is now non-QM. Non-QM in and of itself is extremely diverse, and it's really not just for investors, it's for anybody that can't fit into those boxes. So for example, if you're self-employed and you can't show tax returns, maybe you can show 1099s or bank statements, right? Maybe that's your means of showing proof of income to qualify for a mortgage. For investors, let's focus on that specific. We've got debt service coverage ratio products inside non-QM. Non-QM also will not care how many finance properties you have. Most of you know that Fannie Freddie, you're capped at 10. So if you can still provide your vials of blood and DNA samples and go full doc, you can go non-QM even if you've exhausted the 10 Fannie Freddies, no limit to the number of finance properties that you have. I have yet to meet an investor that had so many properties that we capped out. In other words, at least to date, 25 years in, I have not been in a position where I've dealt with a client that I couldn't continue to fund. So let's talk about debt service coverage ratio, because I feel like on the non-QM side, that's typically what most investors are going to be looking for if they're looking for non-QM. Debt service coverage ratio, simply, you guys, is we're taking the gross rents and dividing it by the PITI, or in some cases, the interest, taxes, and insurance. PITI, principal, interest, tax, and insurance. We have interest-only products that would be the same calculation, gross rents divided by ITI, interest-only, taxes, and insurance, and HOA if it were applicable. As a quick example, let's say that the gross rents were $1,000 a month, and let's say that the total monthly mortgage payment was $1,000 a month. The debt service coverage ratio of that scenario would be 1.0, right? If the gross rents were $1,250 and the PITI was 1,000, my debt service would be 1.25. Depending on the product, the debt service requirement can be higher or lower. The lowest that it will go and qualifying for the property is going to be 0.75. So in that scenario, let's say that your gross rents are $750 and your PITI is 1,000. That would be a 0.75 debt service ratio. That's the absolute lowest that we have access to. And then there are some products that want to see 1.1 and above. Generally speaking, the higher the debt service, the better the rate's going to be. 1.25 and above is kind of a benchmark for the debt service ratio, where you're going to get a little bit of break on the interest rate. I'm a big fan. I always have been. I know that we've been kind of accustomed to our 30-year fixed principal and interest closed-ended loans. I'm a big fan of the ARM and the interest only that we have access to right now, especially in our rate environment where they've been going up so quickly. Having access to slightly lower interest rates and that interest only, I think, is a real advantage for us to keep that cash flow as strong as possible when we know we're going to be refinancing in a few years anyway. And we also know that on the 30-year fixed, in the first 3, 5, 10 years, we're paying almost nothing towards principal in the first place. So why not take an interest only and save on that cash flow? What else about non-QM, Blake? Did that answer your question? Is there anything that you heard there that drew out more questions?
I think Brock might have had to.
Oh, I said Brock, sorry.
Technology and came back on, but I did say.
Oh shoot.
No, you're. It's why we record these things, so we're all good. From a QM perspective, Caeli, the only other question I wanted to ask that might be helpful for the group is, does that mean commercial?
QM is going to be residential. Those rules do not apply to commercial, and commercial loans. So let me break that down. So you can have a commercial loan for commercial property, and that's kind of what most people, when they hear commercial loan, that's where their head goes. But actually, Ridge has products that we take commercial-like loans, which is a different underwrite, and we can apply those to residential properties, which is another product line that we have access to. This is called cross-collateralization. These are almost always, well, that's not true. You can largely choose between recourse and non-recourse on such a loan, a commercial loan for residential properties. For those that need the reminder, recourse means that you have signed a personal guarantee, which on a residential property will count against the 10 Fannie Freddie limit. Non-recourse means no personal guarantee and will not count against the Fannie Freddie limit. Let me give you a quick example. Let's say that you have, I see this a lot on the commercial cross-collateralization space. You have exhausted your 10 Fannie Freddies, but you want to find a way to keep opening up those spots for Fannie Freddies. And I got this question the other day. The 10 limit is real time. It's not as if you've had 10 conventional Fannie Mae Freddie Mac loans at some point and you never get to have them again. It's if and when those spots are opened. Right. So if you have 10 right now, obviously you don't have access to it. But if you sold 2 or paid off 3, you've opened those spots back up. Someone actually mistakenly assumed that once you've had the 10, you get the 10, you don't get any more. Right. No matter how many you have at the real time. So just FYI. So the scenario would be this. You've got 10 single family residences and you want to buy more properties, and you can look at debt service ratio. We have those products available to you to keep going. But let's say you want to keep looking at the conventional loans as a means of increasing your portfolio. We could look at a commercial cross-collateralization product where we'll take 5 of those single family residence properties and put them into one non-recourse commercial loan, and whereby we've opened up 5 new Fannie Freddie spots. If you had gotten bad information, I see this all the time, that they did this because the loan is in an LLC name, but there's a personal guarantee to it, and they weren't advised appropriately. They took those 5 properties and put it into this commercial loan, but they signed that personal guarantee. All 5 of those properties still count, right? They didn't realize that they needed a non-recourse loan to accomplish the opening of more conventional loan products.
Cool. Thank you very much, Caeli. We did have Francis asked a question about when you brought up debt service coverage ratio loans, is there a cash reserve needed for that?
Yes, good question. Cash reserve is going to be a little bit different on non-QM and debt service ratio, depending on the investor that we're selling to. And what that means, guys, is that we are a direct lender. It means that we underwrite in-house, we fund on our warehouse lines, but we don't service these loans, right? You're not going to be making your payment to us. So we're going to bundle up these mortgage-backed securities and we're going to resell them on the secondary market to what we call aggregators. So just to clarify that. So depending on who we're going to be selling that particular loan to, it could change slightly the reserve requirement on non-QM and in particular debt service coverage ratio. Some of them might be 6 months of the subject property. I've seen it as high as 12 months on the subject property. But generally, and I'm trying to think if there's an exception to this, and I'm not finding one in my mental Rolodex, the reserve requirement should be exclusively to the subject property. So for those that are familiar with the Fannie Freddie guidelines, you know that you've got to ultimately come up with reserves that incorporate or encompass all of your rental properties. Where in the debt service ratio, they only care about the property that they're funding at that point in time. So anything else that you own, you're not going to have to show funds or assets, liquid or non-liquid, to account for those reserves on other properties, just the primary or the subject, the subject property. So I would say that, anywhere between 6 and 12 months of the PITI would be the reserve requirement that you're going to have to meet. I've seen it as low as 3 and 4 months, but I tend to be conservative when you're trying to look at qualifications. So use 6 to 12 and you should be safe.
Thank you very much, Caeli. I know the community has heard a lot about your experiences over the downturns in housing and finance and those kinds of things. Do you have any vibe going back to the cash out, the reasons and methods for cashing out? I know historically you've really promoted that you shouldn't pull cash out unless there's a good use for it. Do you still feel that way right now? If somebody was maybe thinking about doing something, but they weren't quite sure, would you guide them toward taking the cash just in case?
Yes. Even if you're not ready to deploy it right now and it's a matter of waiting where it won't be available anymore for whatever reason, I'm going to say in these circumstances, I'm going to tell you to grab the cash. As long as you've got appropriate cash flow from other properties that can help offset, or the property is still even at a small break even, a little bit of cash flow, I'm going to hesitate to recommend to anybody, and there's exceptions to every rule as always, but I'm going to hesitate to say grabbing cash to the extent or to the point that you've put that property without any offset from another property potentially at a large negative. Now, if I'm going to play devil's advocate, let me take that a little bit further. Let's say you've got a property that you could pull out up to, and you qualify and everything, up to 100 grand. Okay. And in doing that, you've increased your, you're now at a negative. Your monthly income versus the total monthly mortgage payment is $1,000 in the red. You have to feed that property $100 a month to keep it alive. Okay. But you have $100,000 that you're not using yet. You're kind of on the sidelines. You're looking. You have that cash. If you have a decent plan in that example, I may say, fine, that works, because you can use that 100 grand at $100 a month, a clip of $100 a month for 2 years. That's $2,400. Okay. You've got that you can pull from and set aside to keep that property at a baseline break even. We have to assume that you're going to be using it for something somewhere, somehow in the next 6 to 12 months. But so I feel like I contradicted myself a little bit. Generally speaking, I'm going to tell you that we want it to at least break even and it's covering itself. But based on your particular circumstances, if we were looking at it and you've got that much cash that you can access, maybe $100 a month, pull from, like, for 24 months, your safety net, set that aside to cover that. There may be some circumstances where that might be okay too.
Okay. That's okay. It's okay to contradict because everybody's unique. So Caeli, we got a couple questions. First one came in. Does Ridge Lending Group have a second lien Heloc for a rental property? And
We
what
have
would be the requirements for that if so?
Yeah. So second lien HELOCs, I think in general, owner occupied or non-owner occupied, have really dried up. I assume that most people here have done any checking yourselves. You know that that's true. Non-owner occupied, I don't know anybody that has them for investment properties. There used to be a few, maybe 6-8 months ago. Both of the ones that I knew of, which were PenFed and Bank of the West, are no longer offering HELOCs on investment property. We also do not have HELOCs on investment property. What we do have are HELoans. So this is a closed-ended, fixed second lien mortgage. So it's not a HELOC, open-ended revolving. It's closed-ended and open-ended revolving adjustable. Our product for investment is closed-ended, fixed, principal and interest.
Right, fully amortized over that term.
Right.
So I'm gonna lead. I know earlier you mentioned you wanted to get back to the all-in-one, and I'm gonna give you an opportunity here. So Jason asks a question, and this kind of ties in. I don't know if you planted Jason or not, but he says, I just started with TARDIS. So you just came back from a TARDIS trip. So maybe, so that's pretty coincidental. So the question from Jason is, I just started with TARDIS and I have all my extra monthly funds going to pay down the flip. Does the all-in-one still work for someone like me? I also have one rental and putting that extra going to pay down flip. I'm not quite sure that last sentence, but so would an all-in-one, started with TARDIS in August. Jason just let me know privately. So the idea is, I know you want to talk about the all-in-one and how that sweep account really works. And then obviously Jason is new with TARDIS. So how does that line up for someone like Jason?
Hopefully I saw you this week. So yeah, I was in Hawaii with this group, TARDIS guys. It was fantastic. And if I didn't get to say hi, maybe we'll get to meet again, Jason. I think the answer is yes, dependent upon, right? So if every extra cent that you have right now is going to the snowball, this is a TARDIS investment group philosophy. I won't get into that. I may suggest that we run the math, which I'm big on, right? I'm always beating the drums about running the math. Maybe instead of every extra cent that you have going here, maybe we split it up a little bit. How does doing that change the dynamic of the strategy and investment with TARDIS? And what does it gain you over here? Because at some point I would tell you, and playing devil's advocate, if you have access to a property that we could put the all-in-one on today, waiting, I think, is going to be to your disadvantage. So if we were to do that and then split up the extra, right, your discretionary income between the two, maybe it's a 70-30 and 80-20, it doesn't really matter if the numbers still work. Now you're going to have this line of credit in a space where you have, I would expect, more equity today than you're going to have tomorrow or next week or next year or whatever, because the TARDIS for you within their strategy, it starts to change a little bit, right? I think it's after 12 months, they want you to get into real estate, and having that all-in-one in that case already in place is going to be to your advantage versus trying to get it later. So I'd say let's do the math, Jason, and see within your means if it's viable, first of all, today. And if it is, let's try and be proactive and plan for the next 6, 12, 24 months.
Yeah, and I wanted to kind of bring you back to that too. Again, this ties into the investment property, and especially with regards to a HELOC. A lot of folks are focused in on putting a HELOC because they don't want to touch that interest rate on the first. Obviously, you know, to those people, I say they need to really understand how the sweep account works in the all-in-one using the simulator. Is that really the best way to kind of get to that, Caeli?
Yeah, I'm glad you said that, because that's what I wanted to talk about, you guys. I can't tell you how many conversations I'm having right now, and I get it. I mean, I really do get it. And even though there's some psychology on it, the rates that we've been able to get into over the last couple of years are very compelling. Who wants to give those up? Now, I would argue that those of you that have unless you're in your deep retirement years, that has a 2 or 3% interest rate, that you're going to make 360 payments and pay that thing off. I'm going to argue that's probably not likely. Now, exceptions to every rule, right? Maybe that's the case for some of you. But my point is that with the all-in-one, the simulator is a fantastic tool. And maybe, in a couple of weeks, we'll redo that event and go through the simulator together on a share screen. But what I'm learning and finding when I talk to people after they've gone off and done it themselves is that the input and what the simulator is asking for, right? What data it's asking you to input there isn't necessarily what you think, and you are inputting invalid or inaccurate information. So clearly, as a result, the results page isn't what it's supposed to be. So let's say I know the individual's profile pretty well. I know what their income is. I know what their liabilities are, et cetera, et cetera. So they come back and said, the all-in-one looks terrible. I hate it. I'll go through really quickly because I could just plug that stuff in 30 seconds. And then I look at the results page and say, something looks off here. What is it? Then the two of us get together. We run it SIMO, right, on a share screen. And we learned that the input that they have either in the deposit screen or tab or in the spending tab was inaccurate. And that was what was giving them the false positive or false negative on the results page. So I'm such a big fan of this loan product that I would encourage all of you to look at it again, regardless of the interest rate that you have on any mortgage, primary or rental property. And if the results page don't look really great, maybe we should look at it together, or you can save your work and get a key code. Send me the key code along with what your income and your spending habits are if you want, and I'll go in there and look at it for you. I would tell you that 80% of the people that I talk to, real estate investors, the all-in-one beats their 3% interest rate. 80%, that's a big enough number. So when I'm hearing people come back and say, nah, it just didn't look great, or whatever it is, I'm starting to question it because I'm feeling like their interpretation of what it's asking isn't what it really needs to get you the accurate results.
From an owner-occupied loan option, Caeli, do you find that historically clients of Ridge Lending are using the all-in-one for more so for owner-occupied, or do you see a fair number for second homes or investment properties?
I would say that it's a pretty decent mix. However, our advice typically is going to be to put it on the primary residence, because that's going to be the property generally that has the highest value and hence the highest option or availability of limit, right? Your primary residence, two things. One is going to give you a higher credit limit, right? A higher line limit because it's the highest value property, but also an owner occupied all-in-one allows for higher loan to value. So a primary residence lets us go to 80% on a purchase, a rate and term, or a cash out refi, versus an investment property limits us to 75% on a purchase or rate and term and caps us at 70% on a cash out. So for those two reasons, higher value on the primary, higher leverage on the primary, our advice typically is the primary is what you want to use the all-in-one for, because it just gives you that bigger access.
Jason's got a question. So in this market, is there a possibility for the all-in-one to limit access to equity? And so Jason remembers the same thing that we probably all remember, where banks were literally cutting their lines of credit back in the financial crisis. So there you go.
Yeah, it's a very, very good question. And the answer is yes. Now they can freeze credit lines if the value drops to a place where, so for example, let's just say that you have a credit limit of 500,000, okay? And when you started this, the value of your property was 650, whatever that math is. Well, if your property value drops to 450, are they going to let you keep a $500,000 limit when the value of your home is below the line limit? No, absolutely not. They're going to freeze it probably. Now, here's the advice that I give. We're going to have some notification if things are headed to that dire direction. All right. And in which case, what I would be doing if I knew that that was coming is I'm going to draw every cent out of that Heloc that's accessible to me, and I'm going to park it someplace else. Now, they may freeze the limit at where you're at, but they can't reduce it, right? You're not in default. Do you guys follow what I'm saying there? Did I say that in a comprehensive way? So if there is a spread between the limit and what you owe, and we think that values are going to take a significant drop, I'm going to grab all the equity available to me on that Heloc, right? Anything that I can get at, I'm going to take it and I'm going to put it someplace else, so that if my value falls, because the investor's not going to let you keep a limit that is in excess of the new value of the home, right? They're going to drop the credit limit. So in that event, I'm going to take everything in advance. They're going to freeze me at where my balance is. Now, your balance cannot be higher than your limit. So if you max it out, if you owe $100,000 and your limit is $100,000, this limit can never exceed, this balance can never exceed the limit. So deposits are going to have to go in, and as those go in, you're going to be paying it down. And if your credit limit has been frozen at that certain level, right, you're not going to have access to it back, if that makes sense.
There we go.
You guys following me? There's Steve is asking,
Yeah.
Hey, Steve, Doc Wex.
So Steve just follows up, then wouldn't they just lower the limit to what your balance is? It's interesting because not every bank actually cut credit limits. There were a lot of banks that caught the news, and there were a ton of places that didn't actually affect anything. So, Jason, is the reason why you asked the question, just to kind of dig in, because just because you're asking it doesn't mean everybody isn't thinking it. So, is the reason why you're concerned about accessing equity, how does that line up to something else? Like, if you were interested in this concept, you obviously don't have any access to equity in a fixed rate mortgage, and any bank that has a line of credit would have these concerns. So are you asking generally, or are you asking specifically for this one product? And while we're waiting for that answer, we did have another question, so we'll kind of wait for Jason's response. We'll come back to him. So another question here from Ms. Obiha says, what's the easiest way, Caeli, to refinance to cash out of an owner-occupied home without using tax returns?
Owner-occupied, no tax returns. We have bank statement products. We have asset depletion products. 1099, if you have a 1099, we can show those to prove income. I'd want to see your overall circumstance and be able to advise more appropriately. But if you don't have a tax return on an owner-occupied, because there's no debt service coverage ratio product for owner-occupied, right? It's where you live. There's no income to offset. So you've got options for bank statements. We can take 12 or 24 months business or personal bank statements. We're going to add up all the deposits and we're going to divide by the number of months that we've used and come up with an income number. Asset depletion. Let's say you've got a lot of assets, a self-directed IRA, for example. Even if you're not of retirement age, depending on how the asset is set up, obviously we'd have to take a look at that. We can advise, or we'll go to your asset facilitator, and we'll set up a regular distribution as long as we have 36 months continuance of that income. That might be another way. Just as an example, I can't do mental math, so I'm going to get my calculator. So let's say that you need $5,000 to qualify. Okay, we need $5,000 times 36. So I need 180,000 in an account, in an asset account that we can set up to take regular distributions from. Now, for the purpose of qualifying, we're going to actually set up the distribution, and you're going to take the $5,000 a month. What you do with it after you take it is up to you. I don't give a hoot. You can put it back into the account. I almost slipped there, didn't I? You can put it right back into the account if you want to, and then after the loan closes, you can remove the distribution. It's entirely up to you. So those would be two ways that I can, off the top of my head, think of that. If you can't qualify using tax returns, you can do that. But I might also offer or add, are you sure you can't qualify using tax returns? Another thing, I can't tell you guys how many times borrowers come to me and say, well, my bank told me I couldn't qualify because my tax returns, right? They didn't add back for depreciation, or they didn't. There's a whole slew of things that either they have overlays for that aren't actually guidelines to the purest form of what a Fannie, Freddie, or FHA or whatever might allow, or they didn't know better. So I would encourage you, if you're absolutely positive that you can't qualify using tax returns, fine. But if you even have this much hesitancy that maybe I can, let us look at it with you and completely exhaust that possibility before we move into a bank statement or an asset depletion.
Yeah, I'm gonna kind of segue this in as we round out the time here together. So one of the great things about Fannie Freddie owner occupied transactions, Caeli, is we get to not think about guidelines. We get to run it through the automated engines and let the automated engines kind of tell us what's needed. So, that's the first thing that jumped into my mind with the question from Ms. Obiha, was to say, hey, listen, let's get your application in and let's figure out what the Fannie Freddie engines actually ask for before you worry about not qualifying. Would you
Yeah,
agree?
because I think that's a great point, Larry. What he's talking about, you guys, so there's something called an AUS, Automated Underwriting System. This is a very robust engine. Fannie Mae has their own unique, Freddie Mac has their own unique. They have their own names, it doesn't matter. But we input all the data and it spits out these findings. These findings are usually 3, 4, 5 pages long. And within the findings, it'll tell us exactly what you need to supply in order for that loan to be insured by the United States government. Okay, so maybe it says that we only need to show 1 year of tax returns, and the other bank was making you take a 24-month average, and that's what killed you. It could be any number of things. That's an excellent point. And you'd said something else that triggered another thought for me. Oh, I know what it was. And remember too, it may not be about the income, right? A lot of times people think they need to make X amount of income in order to qualify, when in fact, it's a lot less about the income as it is the income in relation to your monthly liabilities on your credit report. So let's say that we're able to extract $3,000 a month of income, but your liabilities are only $1,500. I can get you to qualify. Or maybe we look at, in the cash out refinance, we look at paying off some liabilities, right? Maybe we pay off some of the credit cards and reduce the monthly debt. Maybe you have a car payment that's been financed that has less than 10 months of payments left, and you didn't realize that I don't have to hit you for that payment, because guidelines say if you've got less than 10 months on an installment loan, it doesn't have to count in your debt to income ratio. So I'm going down a rabbit hole here, you guys, but I think you get the point. There are a lot of ways to skin the cat. I would want to exhaust all the possibilities, get my vials of blood on file, and then be presented with all the variables and options that might be possible today, and maybe forecasting for the future, right? You can't qualify today based on this, but I can tell you exactly what you have to do to get there, right? So lots and lots of value to go through the qualification process and see what we can do.
Caeli, is there anything, as we're rounding out here, I don't have any more questions coming through the chat. With regards to opportunities, there's a lot of news rolling out right now with regards to home prices falling, interest rates rising, people getting laid off, housing applications, or excuse me, mortgage applications and housing starts are all down. Lots of negative news that makes you feel like you just want to crawl inside of your shell and don't do anything. What have you seen work over the years with regards to this? Whether it's on the owner occupied side or second home or even investment properties?
I'm going to take that and focus on the non-owner occupied side, since that's really what we're all here for. You know, first of all, I would say that the sound bites are there to sell magazines and newspapers or you know, clickbait or whatever it is, advertising. So take that for what it's worth. But more importantly, you guys, is more negative it is, the more opportunity that you're going to have as investors. Okay, and we started this conversation off by saying, if you don't have cash, if you don't have $1 million or $100,000 just sitting in the bank waiting for you to use it, utilize your properties, harvest the equity, get in a position that you can start making offers. It's going to be where you don't have 30 people bidding on one property and it upsells 10 and 20 and 50 and $100,000. You're going to be able to see a $200,000 property and probably bid at 180 with seller paid closing costs, and you're going to get the deal, right? I'm seeing it all the time. I had another conversation. I'm probably going to take us over time really for a second, but I had another conversation earlier today as a means of finding deep distressed price points. Another way you guys can do that is in the counties or the areas that you're looking to purchase. You can look on the county website. There are courthouse step sales, fire sales, sheriff sales is what they're called. You can't see the inside of them, but you can get lists of where the properties are located that are about to go into foreclosure or whatever. This is a little bit separate from what we're talking about. But if you're looking for deep discount properties at a much lower than market value price, you can go and look at these properties. The addresses should be listed there. You can, you know, drive by. You can't get inside and see what the inside condition is, but you may be able to pick up properties far below current market value, right? That are even more below than what the sellers and agents and turnkeys are going to be selling them for.
Yeah, and I think that's, you know, the point is, if you're here to be an investor, you have to be an investor whether it's tough or easy, right? You know, that's the job that you sign up for. So for today, so here's some just a recap for what we went over. Borrowed funds are non-taxable. Non-QM is available in Ohio as well as 46 other states with Ridge Lending Group. Commercial loans to residential properties, including non-recourse, are out there. Debt service coverage ratio loans reserves are specific to the property. You should use a simulator. I put a couple of links in the chat. You can certainly go to ridgelendinggroup.com, but I put the specific links in there for the all-in-one simulator. If you do run the simulator, please reach out to Caeli at Ridge Lending at 855-74-RIDGE or email to info@ridgelendinggroup.com. Set up a time to review that. And you know, as Caeli says, always position yourself now to be prepared for the next deal when you're given. And there are starting to be some deeply discounted. I saw a news clip yesterday. I think it was foreclosures are up 15% month over month. And unfortunately, that's probably going to come up even more. Are there any specific loan programs that you wanted to plug besides the all-in-one, Caeli, that you see people taking advantage of?
Well, it's new to us, and I'm going to hesitate to give you guys too much intel. We'll probably get into it next week. We are on the precipice of offering a cross-collateralized line of credit for investment properties. So when you guys have heard me talk about lines of credit, or excuse me, cross-collateralization, those are institutional, right? They're going to be arms or fixed, right? They're closed-ended. We are going to have access to open-ended lines of credit on a cross-collateralized basis. The minimum credit limit is $1 million, right? So you're going to have a decent portfolio, but we can look at lines of credit across 3 or 4 or 5, 6, 10 different properties that we're finding a lot of investors are very interested in. More details to come on that. That's the little hook, right? I grabbed you. So we'll see you guys next week, and I'll have more more details about what that loan product looks like.
You're so sneaky. You teased everybody and you're not gonna, it's terrible. So thank you everybody for coming today. Caeli, thank you very much for giving us more information. As always, again, any questions, just call into Ridge Lending, 855-74-RIDGE. And keep showing up to the community. You guys are fantastic on the community asking questions. We'll put this replay up ASAP, and we'll catch you next Tuesday.
Thanks, guys.
Thank you, Caeli. See you, everybody.
See ya.